Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Today's episode is entitled, What is Mortgage Planning and Why You Should Care? What in the world is this thing called mortgage planning? Most advisors don't talk about it. Most people have never even heard of this. The extent of the mortgage planning that most people hear is the horrendously terrible, outdated advice. You should pay off your mortgage. You should pay extra principal payments because it saves you interest, and it absolutely does not. Well, it does save you interest. It just costs you more than you're saving and creates risks in your life that you do not need. So today's episode is an introductory episode for an entire week on mortgage planning because I, Charlie Jewett, think that mortgage planning, the mortgage tool itself, is probably the most powerful tool in the financial services. It is certainly the most overlooked. Now, why do we hate mortgages so much? Man, people hate mortgages. They believe that paying interest to a bank for a house you can't afford and can't live in without their help is somehow bad or wrong. This 3 to 4% we're paying at the recording of this, it's about, it's under, I think it's at 3.1 right now. It's ridiculous for veterans and probably for regular folks. It's, mid threes, high fours, something like that. Why do people hate this so much? It's tax deductible. If you're paying 4% and writing it off on your taxes, your net costs are probably 2.8 to 3%. Why do people hate it so much? Well, you have to go back and look at a little bit of the history. Before the Depression, we didn't have 30-year fixed mortgages. We didn't have mortgages that were disappearing, where you were paying it down. So, people would go into the bank and say, I want to borrow $3,500 to buy this 3-bedroom house. The bank would say, sure, we want to lend it to you. They'd give them the documents. The person would read the documents and say, whoa, time out. It says right here that you can call the note due anytime you want to, and we only have 90 days to come up with all the money. I don't like that. The bank says, no, don't worry about that. We don't want your money or else we wouldn't be lending it to you. We want the interest. And so people signed on the dotted line, said that makes sense, and bam, they get a mortgage. Then the Depression hits. Now, the Depression didn't only hurt regular people. The Depression hurt institutions. It hurt banks. We lost 5,000 banks during the Depression. It hurt them bad. So what did banks do when they were hurting for money and they needed to get money? They went back and called some or all of those mortgages due that they told people, we're not going to want the money, but they did want the money. Now they needed it. So good Americans, our ancestors who paid every single mortgage payment on time, lost their homes and had to move out because they had a mortgage. So yes, it's understandable for those people to say, mortgages are dangerous, mortgages are bad. However, the rules changed, and it changed everything. So we can say today, mortgages where they can call the note due and you have to pay them back in 90 days are dangerous. I'm fine with that. The problem is they came out with a 30-year fixed mortgage right after that, where you're paying down the mortgage, eventually paying off the house, and those mortgages don't have that clause inside of them. As long as you are making your monthly payment, the bank cannot call the note due, and it literally is night and day. It changes everything you've ever been taught about mortgage planning or paying off mortgages. Now, we've got to look at something important here. Someone that says to you, you should pay off your mortgage because debt is bad, paying interest is bad, that's a very inaccurate and amateur thing to say. If paying debt or paying interest is bad, then banks and insurance companies are the stupidest people on the planet. Why do I say that? Look at any bank and look at the advertisements. They may even be on two windows. One window in the front of the bank might say CDs, 2%. The other window might say car loans, 4%. Well, what money are they using to lend for car loans? Yes, the money that people gave them for the CDs. Banks exist to pay interest. They're trying to get into debt. When they ask you to come in and open up an account or take out a CD or a money market or whatever they're doing, they're trying to get you to deposit money in the bank and they'll pay you interest. It's terrible right now. That's fine. They're trying to pay interest. Why? Are they stupid? No, it's because they know they can earn more interest. It's called arbitrage. It's just as old as wholesale retail. Wholesale retail means buy low, sell high. Arbitrage means borrow low, lend high. Same thing for insurance companies. If you look at the books for any insurance company, look at their financial books, you can see a column that says total liabilities. That means if every single person canceled their insurance policy, canceled their annuity, if everybody called on the same day, and for the first time in history we had a run on the insurance companies, which we've never had. We've had run on the banks, but we don't have run on the insurance companies. If everybody wanted to cancel on the same day, this insurance company will just pick one out of thin air, says, okay, we owe $34 billion. Oh, great. Well, that's a lot of debt. How much do you have in assets? You look at their total assets, it says $36 billion. So they have $2 billion more than they need to pay their debts off in any given day. Why don't they just pay off their debts? Haven't they heard the financial pundits? Haven't they heard my competitors out there barking about how bad debt is and how stupid you are to have debt and how you need to pay off your mortgage and blah, blah, blah? Haven't they heard? Why don't they pay off their debts when they have all the money to do it? Because they know it would be the worst financial decision in the world. They'd go out of business. They've got $36 billion that they're making 6% on in their bond portfolio, and then they owe $34 billion, and they're paying probably the equivalent of 3 or 4%. Well, if you're borrowing at 4 and earning 6, you're actually making a 50% rate of return using arbitrage. No human, no bank, no insurance company in their right mind is going to give up the chance to make a 50% rate of return. The problem is, the bad guys exist, whether it's through ignorance or immorality. The bad guys exist to keep you from being in your right mind and to purposely put you into the wrong mind so that you continue to do what they say. I literally get paid commissions just like every insurance agent on the planet. Anybody who has an insurance license like I do as part of the full service comprehensive financial planning, if they have a license and they're an insurance agent, we get paid commissions to get insurance companies into more debt. They're literally paying people to get into debt. Maybe you should revisit the concept of arbitrage or the way that the people with the most money picture debt. Not broke people, not people that write silly books with bad advice, but the people that really know what they're doing and have more money than anybody. What do they say about liabilities? What do they say about debt? Everything you're trying to accomplish by paying off your house can be accomplished better another way by not paying off the house. You want safety? Holy cow. Having all the equity sitting inside of your house is not safe. Wait for some of the future episodes this week. You want to be financially sound? You want to make wise decisions and do what's best for your family financially? Don't get rid of your debt that's costing you 4% and give up making 6% on all the money it takes you to do that. Keep the debt and keep making the money and pocket the 50% rate of return. You want to avoid slavery? People say that being in debt is slavery. That's false. Being in debt that you cannot pay off is slavery. My book, The 2 Ways to Be Debt-Free, proves there is no slavery if you have a mortgage of $400,000 and you have that $400,000 sitting somewhere that it can't be lost. You can pay off your debt anytime you want to. You just snap your fingers. There's no slavery. People, in this week's episodes, I'm going to just hammer where I started my career, which is mortgage planning. You can do more with this tool to lower your taxes, to increase the amount of life insurance in your life, to increase the amount of long-term care you're carrying, to protect yourself from depreciation, to get your money making more money. You can do more with the mortgage than any other tool on the planet, and it's the most misunderstood tool. So, what is mortgage planning? Mortgage planning is the decision for what size of a mortgage to use or to keep, what type of a mortgage, whether you do a 10-year, 15-year, 30-year, those types of things, how much of your home to finance, how big of down payments, where do you keep your home equity if you're not going to store it inside of a house, and why should you care? Because literally everything in your life can get better than it is today if you do not pay off your mortgage. So, listen in tomorrow. We're going to start talking about this, where mortgages fail the liquidity test, they fail the safety test, they fail the rate of return test, and they fail the tax treatment test. Mortgages or home equity fail every single test of a wise investment that we have, and you need to know it. So tune in tomorrow, because you people are the best.
Renovating. Retirement. With Charlie Jewett.
But that's all, folks.